A few years into my real estate journey, I made a decision that surprised a lot of people around me. I stopped buying single family rental homes. And now, if you watched week 3 of the series, you know that I am a huge believer in single family rentals as a starting point for building wealth. And I stand by every word I said in that video. But here is what I also know. Starting there does not mean staying there forever. There is a next level, and today I'm going to take you inside of it. We're talking about multifamily syndications, one of the most powerful wealth building vehicles available to mid career professionals, and one of the most misunderstood. By the end of this video, you are going to understand exactly what it is, how it works, and whether it might be the right next move for you. I'm Coach Lee Johnson. Let's level up. Subscribe and hit the bell if you haven't already. We drop content every week for mid-career professionals who are serious about building real wealth. And if you're new here, go back and watch week 3 on the single family rentals first. It will make today's conversation even more powerful. Now let's get into it. What is multifamily syndication? Let me start with a definition in plain English, not Wall Street jargon. A real estate syndication is simply a group investment. A sponsor, also called the general partner or GP, identifies a large multifamily property, a 50-unit complex, for example, negotiates the purchase, secures the finances, and manages the deal from acquisition through sale. Then they raise the remaining capital needed for the down payment and operating reserves from a group of passive investors called limited partners or LPs. As a limited partner, you can invest a set amount of capital, often a minimum of $50,000 to $100,000, in exchange for a proportional share of the cash flow and profits when the property sells. You are a passive owner. You don't manage tenants. You don't take maintenance calls at midnight. You don't deal with leases or repairs. You invest. You receive quarterly distributions, and you wait for the exit. Syndication is how everyday investors access institutional quality real estate deals without having to run them yourself. Most syndications are structured as private security offerings under SEC Regulation D, which means they are typically available only to accredited investors, people with a net worth over $1 million, excluding their primary residence, or having an annual income of $200,000 or more for individuals and $300,000 for couples. If you are not yet accredited, don't tune out. We'll get to that section later. So, why did I make the shift? And more importantly, is syndication right for you? Let me give you an honest side-by-side comparison. Control. With single-family rentals, you are in control. You choose the property, you set the rent, you pick the tenants, you decide when to sell. That control is very empowering and also time-consuming. With syndication, you hand the operational control to the sponsor. Your due diligence shifts from property evaluation to sponsor evaluation. You are betting on the team as much as the deal. Time commitment. Single family rentals even with the property manager, require your attention. Tenant turnover, capital improvements, market monitoring, refinancing decisions. It is not fully passive. Syndication is as close to truly passive real estate as most investors will ever experience. Once you've wired your investment, your job is to review quarterly reports and answer the phone when distributions arrive. Scale. This is where syndications change the game. Buying single-family homes, one at a time, is slow. Meaningful scale requires years of acquisition, management, capital recycling. A single syndication investment can give you a fractional ownership stake in 100, 200, or 500 units overnight. The income potential and equity upside at that scale are simply not available through individual single-family rental investing at the same speed. Minimum investment. This is the honest trade-off. Single-family rental investing can begin with the 15 to 20% down payment on a $200,000 home, roughly $30,000 to $40,000 all in. Most syndications require a minimum of $50,000 to $100,000. That is a higher bar, and it is real. It means syndication is typically a second step after you have built some capital, income, and investing confidence. Tax advantages. Both strategies offer significant tax benefits, depreciation, cost segregation, and potential for tax-sheltered cash flow. Syndications, particularly large commercial deals, often use accelerated depreciation through cost segregation studies that can generate paper losses far exceeding your actual cash investment in year one. For high-income earners, that tax efficiency alone can make syndications extraordinarily attractive. Single family teaches you the game. Multifamily syndications let you play at a different level entirely. How to evaluate a syndication deal. All right, so how do you actually vet a syndication opportunity? Because not all deals are created equal, and the wrong sponsor on the wrong deal in the wrong market can cost you real money. Here are the 5 things I look at before writing a check. Number 1, the sponsor's track record. This is number 1 for a reason. Has this sponsor successfully completed syndications before? From acquisition through full cycle exits. Have they returned investor capital, and have they hit their projected returns? Talk to their previous investors if you can. Look for consistency, transparency, and experience across multiple market cycles, not just a hot run during a bull market. 2, the market. Is the property in a market with strong population and job growth, landlord-friendly laws, rising rents, and low vacancy? I look at Sunbelt market cities closely. Cities like Dallas, Phoenix, Nashville, Charlotte, Atlanta have all shown consistent multifamily demand. Avoid markets where the fundamentals are driven by a single employer or industry. Number 3, the deal structure. Understand the preferred return, the equity split, and the waterfall. A common structure might be an 8% preferred return to LPs, then a 70-30 split on remaining profits, 70% to LPs and 30% to the GP. Know what you're getting into. If the sponsor can explain the structure clearly, that is a red flag in and of itself. 4, the business plan. Is this a value-added play? buying an underperforming property, renovating units, and raising rents, a stabilized cash flow deal, a development project. Each carries different risk and return profiles. I prefer value add deals with a clear, executable renovation plan in a growing market. Know what the sponsor is promising and how realistic it actually is. The exit strategy. Most syndications target a hold period of 3 to 7 years before selling. Understand the projected sell price assumptions. Are they conservative or optimistic? What happens if the market softens and they can't sell at the projected cap rate? A good sponsor has a plan B. If you can't find one in the investment materials, simply ask for it. In syndication, you are investing in people first and property second. Choose your sponsors the way you choose your partners. How to get started. So, if this sounds like the right next step for you, here is your path forward. First, get accredited. If you are not yet an accredited investor, make that your financial goal. Work on maximizing your income, paying down debt, and building your net worth. The real estate building strategies from the previous week of this series are your roadmap to accreditation. It is not as far away as you may think. Second, get educated. Read books like The Off-Hands Investor by Brian Burke and Investing in Real Estate Private Equity by Sean Cook. Join investor communities where syndication deals are discussed, both online and in person. Build your recognition pattern before you invest a single dollar. Third, build relationships with sponsors before you need them. The best syndication deals are oversubscribed quickly. They fill up within days or even hours of opening to investors. The sponsors share their best deals with investors they already know. Start attending real estate investor events, joining masterminds, and getting on sponsors' email lists now before you're ready to invest. And fourth, if you want a guide for this entire journey, that is exactly why my VIP coaching program is designed for. From building the capital base to evaluating your first deal, I walk alongside you every single step of the way. The best time to build great relationships with great sponsors is before you have money to invest. The second best time is right now. Here is your action step this week. Go to Bigger Pockets, Immigrant Wealth Builders, or any multifamily investor community online and find one syndication deal that has recently closed. Read the deal summary. Study the projected returns, the market, the business plan. You are not investing today. You are building the investor's eye. That is how it starts. Drop a comment below. SFR or syndication? Which strategy speaks to you right now? There is no wrong answer. They serve different seasons of your wealth building journey. I want you to know where you are. If you are ready to build a strategy around your specific situation, your income, your timeline, your goals, apply to work with me at transformwithvip.com. The link is in the description. I'm Coach Lee Johnson. The next level is real. It is available and it has your name on it. I'll see you next week.